All right. Um, this model or stock valuation process is referred to as the supernormal growth stock. Sometimes they refer to it as the variable growth stocks. Supernormal, I think, is a little bit more self-expressive of exactly what's going on here. So let's just walk our way through the variables and talk about the scenario. The current dividend for this company is $1. The company has a historical growth rate of 8%, or we might say that that is the industry average growth rate. What has happened, though, is this company has a new invention. They've have a new product line. They've bought a new company. They've created an innovative process for production that's going to increase the earnings of the firm in a dramatic way. However, that's not going to be there forever. Eventually, competition is going to take that away. So what we're estimating here is that for the next couple of years, the supernormal growth rate is going to be 15%. And we've estimated that to last for 4 years. Now, at the end of 4 years, the growth rate of future dividends beyond the 4th year is going to return to the 8%. The required rate of return on this stock is 10%, and the current stock price is $65.50. So how does the process work? Well, essentially what we do is we calculate the future dividends for the first 4 years in this super growth process, and we find their present value. So these rows here, these are the present values of the future dividends, and if you sum those together, they're worth $4.48 in today's money. We also then need to predict what the price is going to be at the end of this 4th year, and we do that using the dividend growth model. We have the dividend at the end of the 4th year. We're going to calculate the dividend in the 5th year. We know the required return's 10%. We know the growth rate moving forward is 8%. So the present value of that future price is $64.51. And when you add those two together, this stock has a value of $68.98. Compared to the current stock price of $65.50, obviously we think that this stock has some potential. It has more value than what the current stock price represents. Again, this is there aren't a lot of companies like this, but any company that's in a growth industry like technology, pharmaceuticals, lots of those companies have very innovative events that really change the focus of the economic playing field, if you will, especially for that industry. So from time to time, it's important to look at companies and say, well, you know, the dividends are not going to grow at a constant growth rate. They are going to have these spurts. And this supernormal growth stock model can help us take that into account. So that is the supernormal growth stock valuation model.